Hello everyone, welcome back to Faceless Business School. Today, we are diving into IFRS 1, a standard that helps companies transition to international financial reporting standards for the first time. We will break it down into easy to understand sections with real-life examples. By the end of this video, you will have a clear grasp of IFRS 1. Let's get started. IFRS 1 stands for International Financial Reporting Standard 1, first time adoption of international financial reporting standards. Its primary purpose is to ensure that a company's first IFRS financial statements are transparent, comparable, and provide a suitable starting point for financial reporting under IFRS. Before a company adopts IFRS, it will usually present its financial statements using local generally accepted accounting principles. So this standard IFRS 1 helps companies transition to presenting their financial statements using international financial reporting standards. The objective of IFRS 1 is to ensure that a company's first IFRS financial statements provide high-quality information that is 1. Transparent for users and comparable over all periods presented. 2. Provides a suitable starting point for accounting under IFRS. And 3. Can be generated at a cost that does not exceed the benefits. This objective ensures a smooth transition to IFRS, enhancing the credibility and comparability of financial statements. Let's start with the transition date. The transition date is the date when a company first adopts IFRS for its financial reporting. Let's take an example using a company called Majesty Nuts. Majesty Nuts has been using local, generally accepted accounting principles. They decide to adopt IFRS starting January 1st, 2024. Their first IFRS reporting period ends on December 31st, 2024. January 1st, 2024 is their transition date. Next, we have the opening IFRS statement of financial position. On the transition date, companies need to prepare their statements as if they had always used IFRS. Majesty Nut needs to adjust its balance sheet from local, generally accepted accounting principles to IFRS as of January 1st, 2024. This includes adjusting assets, liabilities, and equity to comply with IFRS standards. Mandatory exceptions. IFRS 1 includes some mandatory exceptions to ensure consistency and reliability. These are rules that must be followed without exceptions. 1. Estimates. Companies cannot use hindsight to create or adjust estimates. The entity must use the inputs and assumptions that had been used to determine previous generally accepted accounting principles estimates as of that date, after adjusting to reflect any differences in accounting policies. The entity is not permitted to use information that became available only after the previous GAAP estimates were made, except to correct an error. 2. Derecognition of financial assets and liabilities. Companies must follow IFRS rules on derecognition, meaning they can't recognize items that would not meet IFRS criteria. 3. Hedge accounting. Companies can only apply hedge accounting prospectively from the transition date. Voluntary exemptions. To ease the transition, IFRS 1 provides voluntary exemptions. These are optional aids to help with the process. 1. Business combinations. Companies can choose not to restate their past business combinations under IFRS. 2. Fair value as deemed cost. Companies can use fair value as the deemed cost for certain assets. 3. Employee benefits. Companies can elect to recognize all cumulative actuarial gains and losses at the transition date. Disclosures. Transparency is crucial in IFRS. IFRS 1 requires detailed disclosures to explain how the transition affects the company's financial position. 1. Reconciliations. Companies must provide reconciliations of the equity and total comprehensive income from the local generally accepted accounting principles to IFRS. 2. Explanation of adjustments. Companies need to explain significant adjustments made during the transition. Presentation and classification. Companies need to ensure their financial statements follow IFRS presentation and classification rules. This might involve reclassifying items to match IFRS requirements. The role of IFRS 1 in ensuring a smooth transition. IFRS 1 plays a significant role in ensuring a smooth transition from local, generally accepted accounting principles to IFRS. By providing a clear framework and allowing certain exemptions, it helps companies transition without overwhelming them. This enhances the comparability and reliability of financial statements globally. Preparing for future reporting. The goal of IFRS 1 is to set a solid foundation for future financial reporting. Once the initial adjustments are made, future financial statements should follow IFRS standards without needing major changes. Let's take a real-life example and a brief case study to see how IFRS 1 is applied. Imagine a company transitioning from the local, generally accepted accounting principles to IFRS. 1. Transition date, January 1st, 2023. This is the date when a company first adopts IFRS for its financial reporting. 2. Opening IFRS statement of financial position. Adjustments are made to reflect IFRS standards. 3. Mandatory exceptions. Estimates are not changed with new information. 4. Voluntary exemptions. The company opts not to restate past business combinations. 5. Disclosures. Detailed reconciliations and explanations of adjustments are provided. 6. Presentation and classification. Financial statement items are reclassified to match IFRS standards. Through these steps, the company ensures a seamless transition, aligning with IFRS standards effectively. The company benefits from a structured transition process, enhancing global comparability. And that's it for today's lesson on IFRS 1. I hope this breakdown makes the standard clearer and easier to understand. If you found this video helpful, please give it a thumbs up and subscribe for more lessons. See you in our next class.